Welcome to Voice Daily Finance, the most important news personalized for you every day. Supported by Voice.com.
In today's episode, you'll learn about, first, heading into today's open, futures climb on record highs, but a dangerous divergence with the Nasdaq lurks beneath. Watch for the opening bell to reveal if this rally is real or a low volume trap waiting to spring. Second, Nvidia surges pre-market on shocking US policy reversal. Powerful H200 AI chips are now greenlit for China. This isn't just a win for Nvidia, it's a high-stakes gamble. Will Beijing approve the deal and sacrifice its own chip industry, or will this massive revenue stream evaporate at the open? Finally, profit massacre at Southwest. Earnings plummet 42%, but the stock skyrockets near a 2.5-year high. The market is ignoring today's bloodbath for tomorrow's promise of a $1.5 billion payday. A record close that feels more like a warning signal than a victory lap. While the S&P 500 touched fresh all-time highs, the engine driving this market is sputtering, and smart money is already quietly heading for the exits before the holiday lights go out. The S&P 500 pushed to a record close near 6,938, gaining roughly 0.4%, but the headline number masks a fragile reality. Trading volume collapsed to just 40 to 50% of normal levels, a classic liquidity vacuum where prices drift upward on inertia rather than conviction. Crucially, while the broad market celebrated, the tech-heavy Nasdaq failed to join the party at record highs. This divergence, where the generals lead but the troops do not follow, historically precedes sharp volatility when institutional desks return in January. Why is this divergence so critical right now? It signals that the unified front of the bull market is fracturing due to valuation concerns. We are looking at a paradoxical economic backdrop. On one hand, third quarter GDP was revised upward to a robust 4.3%. On the other, the labour market is showing cracks specifically where it hurts consumption. Most unemployment among college-educated workers has risen significantly from 2022 lows. This complicates the picture for the Federal Reserve. After delivering 75 basis points of cuts, Chair Powell and the committee are signalling a pause. The market is now pricing in a hold on rates through early 2026 to assess whether inflation, currently sticky at 2.8%, will reignite. This policy stance changes the calculus for equity valuations. When money is free, investors pay any price for future growth. When the Fed pauses with rates near 3.5%, valuation scrutiny returns. Analysts point out that the massive rally in mega-cap technology stocks is built on capital expenditure projections that are becoming increasingly difficult to justify. Goldman Sachs research notes that for current tech multiples to hold, AI spending needs to hit levels not seen since the dot-com telecom bubble. If those speculative returns on investment do not materialize, the market faces a significant repricing risk. This is why we are seeing a distinct rotation under the surface. The smart capital is moving from the hope trade to the infrastructure trade. While Nvidia and Tesla lag the broader rally, data storage and memory companies are delivering massive outperformance. SanDisk has posted triple-digit returns year to date, and Micron Technology saw net income jump 175%. The logic here is brutal but sound. Hyperscalers, the massive cloud providers, must buy memory and storage chips to build out their data centers regardless of whether their AI software is profitable today. This sector, often tracked by semiconductor ETFs, offers earnings visibility that is decoupled from the speculative frenzy of direct AI applications. Simultaneously, a defensive rotation is evident in the commodities market. Geopolitical friction is putting a hard floor under asset prices. With tensions escalating regarding Venezuelan sanctions and ongoing instability in the Middle East, WTI crude has climbed for 6 straight sessions to near $59 a barrel. More telling is the action in gold, which is sitting at record highs. When stocks hit all-time highs and gold hits all-time highs simultaneously, it indicates that institutional portfolios are aggressively hedging against tail risks. They are buying the rally, but they are terrified of the landing. The energy sector, tracked by ETFs like the XLE, is finding tactical support here. While the long-term supply picture remains heavy, the short-term geopolitical risk premium is forcing traders to cover short positions. This suggests that the next leg of market performance may not come from the familiar tech giants, but from real assets and industrial cyclicals that benefit from supply constraints. The market rhythm has shifted from aggressive accumulation to tactical distribution. The low volume drift of late December often masks the true institutional sentiment which will reveal itself when full liquidity returns in January. The key indicators to watch in the coming weeks are the Nasdaq's ability to hold the 605 support level and the upcoming employment data. If labour weakness accelerates while inflation remains sticky, the soft landing narrative will be challenged. The next few sessions are not just a holiday drift. They are the observation period for a potential regime change in 2026. The most unexpected news in the AI world today has to be a major policy reversal shaking up the global race. The Trump administration has reportedly given the green light for chipmaker Nvidia to ship its powerful H200 artificial intelligence chips to China, undoing a previous ban. We previously flagged export controls as a risk. Now, this partial reversal tests a new strategy for the China-facing AI supply chain. However, if you zoom out, you'll see another layer of strategy at play. This isn't just about one company. It may signal a major shift in US policy from outright denial to what some experts call managed technological diffusion. The idea is to slow China's AI progress rather than halt it, all while letting American companies book revenue. This is a leading indicator for US-China tech relations and could reinforce the inflationary trend in core tech components we've discussed before. This is a massive development for Nvidia, ticker NVDA. According to sources, the H200 processors are roughly 6 times more powerful than the downgraded versions previously designed for China. Nvidia's strategy seems to be monetizing this powerful but not brand new inventory to recapture market share before China's domestic competitors can catch up. And as we know, the real bottlenecks are often in complementary parts like high bandwidth memory, so even previous gen chips can remain scarce. This policy shift comes with a key condition. A 25% fee will be applied to these sales. Now, get this. This isn't a typical tariff. The introduction of a specific fee on a specific high-tech product could be pioneering a new geoeconomic tool, a kind of tech tariff. It could become a template for other strategic technologies, generating revenue for the US while imposing extra costs on rivals. This is exactly the kind of mechanism that can keep the semiconductor producer price index elevated. The numbers here are staggering. Initial orders could reportedly total up to 80,000 H200 AI chips, with shipments planned before the Lunar New Year. Tech giants like Alibaba and ByteDance have expressed strong interest, potentially unlocking a massive revenue stream for Nvidia. This mirrors what we've seen with other concentrated buyers in AI, but with a different cast of characters. But that's not the whole picture. The real turning point is how this could recalibrate the entire AI hardware supply chain. If a significant portion of this scarce H200 capacity goes to China, it could tighten supply for other regions. Actually, this might raise prices or create shortages for second-tier cloud providers who can't get their hands on Nvidia's latest chips, further straining an already tight build-out. The deal, however, is far from certain. The situation presents a fascinating duality for Beijing. It's the classic buy versus build dilemma. While its tech industry is hungry for this hardware, allowing these imports could slow progress for China's own domestic chip industry and its goal of self-sufficiency. Approving these imports would signal a prioritization of short-term AI development over that long-term strategic goal. The entire plan is contingent on approval from the Chinese government, with one source stating, "Nothing is certain until we get the official go-ahead." This sets up a critical dynamic. Watch shares of Nvidia, but also look for ripples across the semiconductor sector, which you can track via an ETF like SMH. The potential for a huge new market is now weighed directly against the uncertainty of a deal that hangs on Beijing's final word. And keep an eye on those indicators we've been tracking, hyperscaler CapEx and the semiconductor PPI, to see if this tech tariff era locks in higher costs across the AI stack. Speaking of high-stakes gambles that could reshape an industry, a stunning disconnect is unfolding in the airline sector. While Southwest Airlines reported a staggering 42% drop in profits, its stock, ticker LUV, is soaring. Ahead of the bell, shares are trading near a 2.5-year high, up nearly 24% this year. So the thing is, we're looking at a classic story stock scenario. The market is pricing in a massive execution premium, betting on a future promise rather than today's reality. This creates a huge gap that could trigger a sharp correction if they stumble. That performance is crushing rivals like Delta and United, and the reason is a high-stakes bet on a complete identity shift. Investors aren't looking at the profit slump, they're betting on a radical transformation. This decision to abandon its decades-old playbook brings both a massive potential payday and comes with inherent brand risks. You know, this isn't happening in a vacuum. The entire airline industry is moving towards a model based on ancillary revenue money from non-ticket sources like baggage fees and seat selection. Southwest has already grown this to over $1 billion last year, and this new strategy is them going all in. The famous open seating cattle call is officially ending in January, replaced with assigned seats. And for the first time, the airline is selling extra legroom for a hefty fee, like $80 each way on some flights. Interestingly enough, this is also a litmus test for the health of the American middle-class consumer. The uptake rate of these new premium add-ons will be a powerful leading indicator of discretionary spending. Southwest has reason to be optimistic. Recent data shows over half its customers have household incomes over $100,000. Strong uptake would signal consumer resilience, while weakness could flag broader economic strain. The figure driving all this optimism: Southwest projects these changes will generate an extra $1 billion in pre-tax earnings next year and a massive $1.5 billion by 2027. This comes just months after the airline also ditched 2 free checked bags. It's a fundamental pivot to become more like the legacy carriers it once defined itself against. However, this pivot isn't without its dangers. After all, Southwest's historical advantage was its simplicity and speed. A key metric to watch will be its aircraft turn time. By adding complexity, they risk slowing this process down, and that operational drag could erode their efficiency, potentially offsetting the new revenue gains with higher costs analysts are buying in. Barclays recently upgraded the stock, with one analyst forecasting adjusted earnings could surpass $6 per share by 2027. CEO Bob Jordan confirmed that early bookings already reflect the business case for the new model. What to watch at the open is whether this momentum continues. Beyond the stock, keep an eye on an external risk. Boeing Southwest exclusively flies a 737, and Boeing's production struggles create a concentrated supply chain risk that rivals with Airbus fleets don't face. Investors are rewarding Southwest not for what it is, but for what it's trying to become, placing a massive bet that abandoning its maverick identity will be its most profitable flight plan yet.
That's it for today on Voice Daily Finance. Follow, share, and stay tuned for daily updates coming your way tomorrow.